Bridgepoint Group shares jumped 10% on Monday after the London-listed private equity firm announced it would buy Kayne Anderson Real Estate for $1.39 billion, paid partly in 189 million newly issued shares. That reaction is the puzzle. When a listed company issues a large block of new shares to fund an acquisition, it dilutes every existing holder's stake in the business. Markets typically punish that outcome. The textbook read is that the seller captures the premium while the buyer absorbs the cost. Yet Bridgepoint's shares rose as much as 12% at the open and held most of the gain through the session. The provisional answer sits in the structure of the deal, not its price tag. Bridgepoint is not buying a single asset or a leveraged portfolio. It is buying a recurring fee income stream tied to $22 billion in real estate assets under management. When the fee income enters Bridgepoint's consolidated accounts, it alters the earnings denominator against which the new shares are measured. The deal also does something structural. It closes the last white space in Bridgepoint's private markets map. The combined group will cover private equity, credit, infrastructure, real estate, and secondaries across $117 billion in assets. Jefferies analysts noted that Bridgepoint has now earned the right to do more deals after a 2024 acquisition of Energy Capital Partners cleared a similar accretion test. So the surface paradox, more shares, higher price, resolves at the level of recurring income. But that resolution raises a harder question: whether the accretion math holds when the real estate cycle that forced Kayne Anderson's peers to consolidate in the first place is not yet finished. The deal's financial logic rests on a 2-year accretion schedule, a mid-single-digit EPS boost in 2027, rising to more than 20% by 2028. Both figures are Bridgepoint's own guidance, cited by Citi in its Monday note reiterating a buy rating. That 2-year lag is where the tension lives. The 189 million new shares enter the share count immediately upon completion, targeted by end 2026. The accretion they are meant to justify does not materialize until the management fee income from Kayne Anderson's funds flows through in full-year numbers, and the larger, contingent 102.5 million additional shares only issue if designated management fee milestones are hit. The dilution is front-loaded. The benefit is back-loaded. In between sits the real estate cycle. Kayne Anderson Real Estate operates across medical office, seniors housing, student housing, multifamily, and light industrial assets in the United States. These are not assets that were stress-tested by falling values. They were stress-tested by financing costs. The wider U.S. real estate industry has seen a wave of consolidations precisely because smaller investors could not afford higher borrowing costs alone and needed scale to access cheaper capital. Bridgepoint is buying into that consolidation, not the recovery on the other side of it. Jefferies framed this as Bridgepoint gaining the full private markets coverage needed to compete with larger rivals. The other read is that Bridgepoint is paying a full price, $1.39 billion including debt, or roughly 6% of its pre-deal market cap, for an asset class that was cheapened by the same rate environment that now governs Bridgepoint's own cost of the $759 million cash component. Citi's note surfaces a detail that makes the accretion claim more testable than it first appears. Management fee revenue guidance has been reiterated by Bridgepoint, but consensus sits well below that level. That gap is not a minor housekeeping item. It is the single most falsifiable input in the 2027 EPS accretion claim. If consensus closes to guidance, the accretion is real. If management fee revenue disappoints, the dilution arithmetic reasserts itself. The monitoring variable is not the completion date in late 2026, and it is not the 2027 annual results. It is Kayne Bridgepoint's fundraising momentum in the months between the deal close and the first full-year fee income print. Bridgepoint's fundraising guidance has been upgraded alongside the acquisition announcement. Citi called out this upgrade specifically, noting it should drive a further positive reaction in shares on top of the accretion story. The upgrade implies that Bridgepoint's deal team believes Kayne Anderson's investor network, which has limited overlap with Bridgepoint's existing relationships, can be cross-sold into the combined platform's other asset classes before the accretion numbers formally land. That cross-sell is the mechanism the market is pricing in, and it is the mechanism most exposed to the real estate cycle. If U.S. real estate sentiment deteriorates before the Kayne Bridgepoint fundraising cycle completes, driven by a second leg of rate pressure or a resurgence in property vacancy in the medical office and student housing sectors, the fundraising upgrade will prove premature. In that case, the management fee gap between guidance and consensus widens rather than closes. The 2027 accretion is deferred toward 2028 at best, and the 189 million new shares look expensive against a deferred earnings stream. The counter-evidence in the pool is thin. The pool records no analyst challenging Bridgepoint's valuation of Kayne Anderson, and Jeffrey's note frames the deal as strategically necessary rather than opportunistically priced. That absence of a named skeptic is itself informative. The risk is not a contested valuation, but an execution bet on fundraising timing. For a holder who bought into the plus 10% session, the move becomes an entry setup confirmation if Kayne Bridgepoint management fee revenue closes toward Bridgepoint's guidance in the first post-completion quarter, the earliest signal that the cross-sell is working before the formal 2027 accretion test. It becomes a trap if management fee revenue tracks consensus rather than guidance, leaving the 189 million new shares stranded above the near-term earnings stream. Watch the first fundraising update from Kayne Bridgepoint, not the deal completion date. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.